The federal long-term care insurance program is currently in a 2-year suspension period that will halt new applications until at least the end of 2024. In this video, we'll cover some of the alarming issues that are impacting the long-term care market, and we'll provide 4 strategies to help plan and prepare for potential long-term care needs for you or a family member. That's coming up, so stay tuned. Hey, welcome to the Money Briefing. My name is Jarrell Harvey, and I'm with Fedway Financial. On this channel, we cover topics related to personal finance, federal benefits, and retirement planning. So if you're new to our channel, please consider sharing and subscribing. Since 2002, OPM has partnered with John Hancock to administer the federal long-term care insurance program. But on December 19th of 2022, OPM officially suspended its long-term care insurance program for at least 24 months. As a result, new applications for coverage are not being accepted. The program will continue to operate normally for the 267,000 federal employees and retirees that currently participate in the insurance plan. However, participants will not be able to increase their coverage during the suspension period. OPM and John Hancock will use the 2-year suspension period to better assess the benefit offers and to establish sustainable premium rates for the program. Even though the news may be surprising to some, OPM and John Hancock are not the only ones on the block that's had to reevaluate their long-term care program. The cost to provide long-term care coverage has caused the market to change dramatically over the past 20 years. And the long-term care industry is currently at a critical crossroad. There are many factors that have affected the industry, but the fundamental factor stems from supply and demand. There is a shrinking supply of long-term care service providers, but there is a growing demand for long-term care services. These services include a variety of things that help support your personal care needs financially, physically, and emotionally. It may also shock some people that most long-term care isn't medical care, which is why there's very limited long-term care coverage included in healthcare plans. Instead, most long-term care helps individuals with basic tasks for everyday living. To trigger many long-term care policies, you have to be unable to perform at least 2 out of 6 activities for daily living or suffer from a cognitive impairment. This list outlines the 6 activities for daily living, which includes things such as bathing, dressing, eating, and moving. But I also want to direct your attention to the instrumental activities of daily living. These include things such as paying bills, taking medication, using the telephone, buying groceries, preparing meals, doing laundry and household chores, and using transportation. It's important to recognize when a person is unable to effectively perform some or most of these tasks because they are often precursors to ADLs or long-term care needs. In fact, studies have shown that 7 out of 10 Americans who reach age 65 will need some type of long-term care during their lifetime. The average length of service needed for all people is 3 years. Since women tend to live longer than men, their average is 3.7 years, and men tend to need their services for about 2.2 years. Based on these numbers, long-term care poses a significant risk to your retirement plan. And given that it's very likely that you will either need care or will become a caregiver at some point during your lifetime, it's important to have a long-term care strategy in place to answer 2 important questions. One is, who will care for you? And the second is, how will you pay for it? So let's first discuss who will care for you. A common misconception about long-term care is that coverage mostly takes place in a nursing home or an assisted living facility. But in reality, most long-term care is provided either in the home of the person receiving services or at a family member's home. In fact, a report that was released in 2021 revealed that 43.5 million Americans provided unpaid care for an adult that is age 50 or over during that year. And 89% of caregivers are related to the care recipient, and 60% of caregivers still hold a full-time or part-time job. I also want to point out Just because a person receives unpaid care, it doesn't mean there are not direct or indirect costs for the person receiving or giving that care. Also, many people are concerned about the different responsibilities that are put on family members if they need long-term care. Oftentimes, individuals who are unmarried do not want to potentially feel like a burden on their children if they have any, or other family members, such as siblings, nieces, or nephews. For married individuals, many of them are concerned about depleting their family savings or leaving their spouse or other family members with unpaid bills. So the second big question to answer is, how do you plan to pay for long-term care? This chart shows the national average cost for the different types of long-term care. I've included the 2023 costs as well as the projected 2043 costs, since many people won't need long-term care until about 20 years after they initially start coverage. As you can see, home care is going to have the lowest cost, while nursing homes are going to be the most expensive. These costs are going to vary based on where you live, so I've included a link in the show notes that also allows you to get state-specific costs. As I've mentioned before, most healthcare programs, including Medicare, provide very limited long-term care support. Medicaid, which is based on income, does provide long-term care coverage. However, most federal retirees do not qualify for Medicaid. I also want to point out, if you're a veteran, some VA benefits may help cover long-term care services, but for the vast majority of federal workers, there are 4 primary options outside of the work program to help cover long-term care expenses. The first option is to self-insure through personal assets and savings. With this option, people normally tap into their investment and retirement accounts to pay for services. Some people may also utilize the equity in a primary residence or rental property. The benefit of self-insurance is that if you don't need long-term care, then the money remains with you or your beneficiaries. On the other hand, the issue with self-funding is whether you will have sufficient funds to cover the costs. The next option is traditional long-term care insurance. There tends to be a lot of flexibility in the plan design with this option, as you can include features such as shared benefits and inflation protection. However, this is a use it or lose it policy, and it only provides benefits for long-term care services. Additionally, there is the potential for premium increases with this option. The third option is a hybrid option between long-term care insurance and life insurance. With this option, premiums are typically guaranteed, and there will always be a payout of benefits through either the payment of long-term care services, a return of premium, or as a death benefit to your beneficiaries. On the negative side, this option may have some limitations with the plan design, and there may be some restrictions with the cash value component. The last option is really a permanent life insurance policy with a long-term care rider added to the coverage. This option also provides guaranteed premiums, and it typically provides your beneficiaries with a high death benefit. On the downside, the long-term care benefit is generally limited to the life insurance value, and there's normally no inflation protection options. Any of the last 3 options can be purchased either directly from an insurance company or through an insurance agent that is licensed to do business in your state. You do have to qualify for long-term care insurance in the private market, and premiums may be impacted by several factors, such as your age, health, gender, marital status, the amount of coverage, and the insurance company. Typically, the sweet spot in terms of age to buy long-term care insurance is between the ages of 55 and 65. Even though the federal long-term care insurance program is suspended for 2 years, there's no guarantee if and when the program will resume for new applicants. There's also no guarantee how good the coverages and premium rates will be. Therefore, if you have some concerns about long-term care, either in the short term or long term, it will serve you well to develop a personal plan on how you want to receive care and how you want to pay for care, whether that's through self-insurance or private insurance. If you received any value from this video, please click the like button. You can also subscribe to our channel to get more content like this. If you have any comments or questions about federal benefits or retirement planning, You can add them down in the comment section below, or you can contact us by visiting our website at www.fedwayfinancial.com. Thank you for watching, and we'll see you on the next Money Briefing.